Hello all, welcome to the second part of the RRSP video. Let's learn more about RRSPs here. First, let's study the difference between the two terms, over-contributions and cumulative excess amount. Over-contributions are also called as excess contributions. Now, how much dollars can be over-contributed? The maximum allowable limit is up to $2,000. And here is the highlight, which is there's no penalty for over-contributions up to $2,000. But remember, this over-contribution amount is not tax deductible. Therefore, it's considered as an after-tax investment. Thus, it leads to double taxation during withdrawal as the withdrawn amount is once again taxed. Now, the second term. What's a cumulative excess amount, CEA? Any amount contributed in excess of the allowable over-contribution limit is known as the cumulative excess amount. A penalty tax of 1% per month is applied on the CEA as long as the excess amount remains in the plan. The penalty is payable by the contributor within 90 days of the end of the year. Now let's see. When can we make a final RRSP over-contribution? Plan holders can over-contribute until the end of the year in which they turn 71 years, provided that they earn income in that year. Based on the plan holder's present income, new RRSP contribution room will be generated for the following year. Therefore, in that year, over-contribution penalties will cease and the plan holder can deduct the contribution. Note that the plan holder must make the over-contribution before transferring the RRSP to a RRIF. That's before the December 31st of the year in which they become 71 years old. Now let's see from which sources can tax-free lump sum transfers be made into RRSPs without affecting the regular RRSP contribution limits. 1. From RPPs, Registered Pension Plans. 2. From D500 RRSP. From other RRSP. Also, by directly transferring amounts into the RRSP, that amount need not be included in income and thus no deduction arises. Next, I'm sure we must have frequently heard of this term, locked-in RRSP or LIRA. So to clarify, let's see the difference between RRSP and locked-in RRSP or LIRA. The main difference is that funds cannot be withdrawn from the locked-in RRSP as they can be from a regular RRSP. Generally, the accrued funds within the Registered Pension Plan RPP must be placed in a LIRA or a locked-in RRSP till the contributor is eligible to receive their retirement income. However, a portion of the funds may be unlocked under certain circumstances, such as during financial hardships, shortened life expectancy, non-residency in Canada, small account balance, etc. These vary by provinces. So now let's see, when can you unlock the LIRA or the locked-in RRSP funds? It can be unlocked only in exceptional cases such as number 1, financial hardships. Depending on circumstances, one can withdraw somewhere between 50% to 75% of YMPE. This YMPE is the year's maximum pensionable earnings, which is $74,600 for 2026. 2. Shortened life expectancy. To qualify, one must have a certificate issued by the physician. Here, the total value of the account can be withdrawn. 3. Non-residency in Canada. One must have not resided in Canada for the past 2 calendar years. In this case, the total value of the account can be withdrawn. 4. Small account balance. To qualify, one's plan membership must have ceased and the value in the RPP account is less than 20% of YMPE. Here also the total value of the account can be withdrawn. 5. Age 55 and over and with a small account balance. Small account balance means lesser or equal to 50% of the YMPE. And for Ontario, the small account balance means having an amount lesser than 40% of the YMPE. In this case, the total value of the RPP account can be withdrawn. And finally 6, age 55 and over plus a one-time 50% unlocking option. It is available in Alberta and Ontario. Step 1 is to convert the funds into LIF, Life Income Fund. And step 2 is to apply for 50% unlocking within 60 days of conversion into LIF. Now let's see a new and a popular concept, which is the spousal RRSP. So what's a spousal RRSP? Spousal RRSPs. A contributor can set up a RRSP registered in the name of a spouse, a common law partner, or same-sex partner. Here, it's not necessary for the spouse to earn an income. The contributor can contribute an amount within their RRSP contribution limit and claim the corresponding tax deduction on their own tax return. This is a tax-effective strategy because the RRSP deduction saves more tax for contributors at the time of contribution and also at the time of withdrawal, especially if their spouse is in a lower marginal tax rate. So to understand this clearly, let's see an example. Rima has a RRSP contribution limit of $15,500 and her husband Manek's RRSP contribution limit is $5,000. Therefore, Rima contributes $10,000 to her own RRSP and contributes $5,500 RRSP. On the other hand, Manek contributes a full $5,000 limit to his own plan and claims a tax deduction for that amount. He need not be concerned about the $5,500 contributed to his RRSP by his wife Rima. Now let's see about the tax treatments for the withdrawals from spousal RRSPs. Funds withdrawn from a spousal RRSP are taxed as income for the recipient spouse, except if the withdrawal occurs within 3 years of contribution to the spousal RRSP. If the withdrawal occurs within 3 years of contribution, then the withdrawn amount is taxed at the contributor's end. So your attribution occurs. The 3 years are not counted from the date of contribution, but from the year of contribution. The time restriction includes the year of contribution plus 2 full calendar years following that year of contribution. Why attribution occurs at withdrawals? Because the most recent contributions are deemed to be withdrawn first. Now let's see the conditions to avoid attribution. No attribution occurs when 1. At least one of the spouses was a non-resident of Canada at the time of withdrawal. 2. When death of the contributing spouse occurred during the year the funds were withdrawn. 3. The couple were living apart as a result of a marriage breakdown. Now let's see an example to clearly understand about the spousal RRSP and the taxation. In each of the 5 consecutive years, John contributes $1,000 to his wife Mary's spousal RRSP. He claims each contribution as a tax deduction in the year it was made. In the 5th year, Mary decides to withdraw all the funds, that's $5,000 from a plan. Therefore, for the 5th taxation year, the couple pays the tax as follows. Since we have this 3-year rule, $3,000 are taxed as income in John's hands and the remaining $2,000 are taxed in Mary's hands. Therefore, a contribution made in February 2021 cannot be withdrawn without attribution until after 3 full years have passed. That's 2021, 2022 and 2023. No attribution occurs when withdrawn in 2024 or later. However, if the funds are contributed later in the year, say in December 2021, 3 full calendar year ends on December 31st, 2023. Technically, just over 2 years later. To lessen the impact of the 3-year rule, it is recommended that you make spousal contributions as late in the year as possible and also that they make no contributions in the first 60 days of the next year. This is very important when the recipient spouse may need to withdraw the spousal contributions as soon as possible without attribution to the contributor spouse. Topic. As we have already seen, funds within RRSP can be withdrawn tax-free before retirement and without penalties only under two cases. One is under the Home Buyers Plan and the other is under Lifelong Learning Plan. So first, let's see about the Home Buyers Plan. This plan is offered by federal government that allows first-time home buyers to withdraw up to $60,000 from their RRSPs to help finance the purchase of a qualifying home. Now let's see the eligibility. To qualify, one or their spouse must not have owned a house in the 4 calendar years preceding the year of withdrawal. For example, to qualify for 2024 withdrawals under the Home Buyers Plan, one shouldn't have owned a house from Jan 1st, 2020. This 4-year qualification period is waived for person with disabilities or for relatives who want to purchase a suitable home for the persons with the disability, and for RRSP annuitants who have experienced a marital or common law partnership breakdown. However, there are other conditions that needs to be fulfilled. 1. The home must be in Canada, be it new or existing. 2. The buyers must purchase or build a home before October 1st of the year following the RRSP withdrawal and occupy it as their principal residence. Otherwise, the funds must be returned to the RRSP or be taxed as income. Then, funds withdrawn for the first time home purchase is eligible and not taxed. But the funds must be repaid through equal annual installments within 15 years. Funds can also be repaid in larger lump sum payments over a shorter period. Payments must begin no later than second year following the withdrawal or within the first 60 days of the third year. So, let's see an example to clearly understand this. Albert and Lily withdraw funds in March 2020 from their own RRSPs under the Home Buyers Plan to purchase a home. They must purchase or build the home and occupy it as their principal residence by October 1st, 2021. Otherwise, they must make full repayment to the RRSP by the end of that year, and any unpaid amount must be included in their taxable income for 2021. Assuming that they do buy the house as planned, the first repayment to the RRSP is due by 2022 or within the first 60 days of 2023. Sure. Now, let's learn about the repayment structure. The minimum repayment amount is calculated as follows. RRSP HBP balance outstanding divided by the number of years remaining for repayment. If less than the required minimum amount is repaid in the year, the shortfall amount must be included in the net income and be taxed in that year it occurs and is treated as repaid. Repayment cannot be made to a spousal RRSP. Funds withdrawn from one RRSP can be made to another RRSP owned by the same plan holder. No further repayments are allowed after the year in which the plan holder reaches age 71. Any amounts unpaid by the end of that year must be included as their income. Special rules apply to participants who would die or leave Canada before they have repaid the HBP withdrawals. Now let's see the advantages and disadvantages of the Home Buyers Plan. The participants of this plan need not make RRSP contributions for the year in which the funds are withdrawn. The participants' RRSP contribution room may be carried forward to the future years. In general, contributions made within 90 days of the withdrawal date cannot be withdrawn. Home Buyers Plan offers home buyers two advantages. 1. Access to an interest-free loan. 2. An opportunity to save on the mortgage interest payments by making a large down payment. A disadvantage is that the borrowed funds stop growing on a tax-sheltered basis until they are repaid. So another RRSP lending program under which RRSP funds can be withdrawn tax-free and without penalties is the Lifelong Learning Plan, which is LLP. The LLP allows the plan holders to finance their education or their spouse's education with RRSP funds. The eligibility criteria is one must be enrolled in a full-time training or a post-secondary education. Conditions of withdrawal are they can withdraw up to $10,000 per year from their RRSP over a 4-year period, but the total amount borrowed cannot exceed $20,000. Amounts withdrawn must be repaid to the RRSP in 10 years, otherwise they will be included in the net income and taxed accordingly. The first repayment is usually due 60 days after the 5th year following the first withdrawal. It may be due earlier in certain circumstances, such as when the student fails to complete the courses. Plan holders using an LLP can also participate in the HBP, that's the Home Buyers Plan, even if the LLP funds they borrowed have not yet been fully repaid. Restrictions: an LLP cannot be used to finance the education or training of the plan holder's children or grandchildren or anyone else. Now let's see, when does an RRSP mature? It matures by December 31st of the year in which the plan holder turns 71 years. Clients holding RRSPs can choose from the following 3 options when their RRSP matures. 1. Withdraw all the proceeds as a lump sum payment. 2. Transfer RRSP proceeds to a RRIF on a tax deferred basis. And 3. Use the RRSP proceeds to purchase an annuity.